Welcome back. Here with us on Trading Hour. Now let's get down to understanding all that Sebi announced yesterday and proposed yesterday with respect to, well, the first part of this is, the framework that's going to come into place when it comes to market rumors. How should they be verified and how should then pricing be looked at, the price of a share or a security where a rumor has been verified when it comes to further corporate action, whether it's a qualified institutional placement or any other corporate action. So that's one part. Plus, there is a draft proposal in the works for a lot of other things, including buybacks, including merchant banker regulation. So let's take it step by step and go across to Yash. For the first part first, Yash, let's talk about this whole market rumor business and this way of finding out what is the unaffected price. Explain it to us.
Well, Surbi, the market regulator, Sebi, has issued guidelines when it comes to managing a stock price in a situation where it's been affected with a market rumor. Now, market regulator Sebi has introduced this concept on unaffected price to mitigate stock price fluctuation. Unaffected price will have to be determined within 24 hours of material price movement, excluding the market rumor. Now, I'll explain exactly what this means. But first, let's come to the purpose. The purpose for introduction of this unaffected price concept is to exclude any sort of price disruption caused by market rumor while arriving at a price for any sort of corporate action, as you mentioned, be it a QIB, OFS, or any sort of corporate action where the price of that share really comes into, takes a center stage. Now, what does the regulation say? Regulations requires listed companies to verify market rumors if there has been a material impact in the price of that share. Sebi circular states that unaffected price shall be considered for the transaction provided that the rumor on this particular security has been clarified by the company within 24 hours. What is unaffected price? It's the share price that would have existed if the impact of this market rumor on that share price is to be excluded. Now, how does one arrive or how does one calculate the unaffected price? Now, the calculation of adjusted volume weighted average price will come into attention when it comes to calculation of unaffected price. If, let's say, a market rumor has come today, then in that case, the change in the volume weighted average price of that security will have to be considered till the end of the trading date tomorrow. Now, once that value has been derived, it will have to be excluded from the average weighted average price of that security to arrive at the unaffected price. I'll just give you some numbers. If, let's say, the price of the security before the market rumor is 100 rupees, with the market rumor on day one, it goes to 105. On the next day closing, it closes at 110. Which means 10 rupees is the incremental impact of that market rumor on the stock price, which will have to be excluded, and the unaffected price, which will have to be considered for any sort of corporate action, will have to be taken as 100 rupees in this situation. As far as applicability is concerned, this new framework will be applicable on the top 100 listed companies starting June 1st, and then another 150 companies, which means a total of 250 companies from December 1st.
Thank you for that. But Yash, Sebi has also released a consultation paper around buyback regulation. What's come over there?
Well, two important changes as far as the buyback regulations is concerned. First one is with respect to the reference date. Now, the reference date for opening or the launching of the buyback will have to be considered as the date when the company announced the intention to go for a buyback. Currently, the date which is to be considered as a reference date for the launch of the buyback is when the company does the board meeting to approve this particular buyback. Second one is conversion of ESOPs or convertible instruments to employees and shareholders. Now, these ESOPs to employees or shareholders will be eligible to be converted through a buyback, which wasn't being allowed by the market regulator so far.
Okay, all right, got it. We have our hands full, Yash. Thanks very much. Lots to discuss. And we have two experts to help us navigate this. Abhishek, Dadoo, partner at Khaitan Co, as well as Sandeep Parekh, founder of Finsec Law Advisors. Gentlemen, thanks very much for joining in. So let's sort of break this up and deal with the market rumor business first to understand if the objective is actually going to be met. So, Sandeep, let me launch this with you. I guess the objective is to ensure that whenever there is a deal happening, ultimately, the pricing of that deal is not impacted by the rumor. Do you think Sebi is able to achieve that with this framework?
I would think so. I think if you read the circular, it's very confusing, but I think the principle is very, very simple. Any impact of the rumor on the price, and even after it's been debunked, because the company gets 24 hours to debunk it, even the future price fluctuation, you remove that the impacted price from the current volume weighted price. So there's a little bit of confusion how to calculate it, because it's not just that 1 day period that you remove, but a much longer period of time which is removed for removing the influence of the rumor from the look back period that is required for basically the floor price of qualified institutional buying mechanism.
We get the pros of this particular, method that SEBI has introduced, Sandeep, but what are going to be the cons, the challenges of introducing this?
I don't think there are any challenges, except it's a little confusing to read for the first time, but I think it's fairly mathematical, and I think I really don't see much of a con in introducing, because I think it reduces the burden on companies who need to kind of price a QIB based on an artificial number. So it's kind of trying to remove that disruption which comes from that artificial number, and I think it's fair both on the investor and on the company. So I really don't see a con to introducing this.
Fair enough. Let's actually bring in our other guest into this as well. Abhishek Dadoo of Khaitan Co. Abhishek, what do you think? Do you think the circular is clear enough? Does it do the job?
First of all, thank you for having me. Absolutely, I agree with Sandeep on all counts. I think it's a very helpful circular. I also think that with some analysis, it becomes clear enough. The idea really being that historically, market rumors or leaks have plagued the public M&A industry. There's a rumor that comes out, stock prices suddenly shoot through the roof, and then the deal in some ways might become commercially unviable. So it doesn't help the people doing the transaction. And at the same time, it doesn't help the regulator or the public, because they don't know what's happening behind the scenes. I think what SEBI's done here is they found a perfect balance. They've actually incentivized the deal makers to go ahead and come out transparently, to say that, look, yes, a deal is brewing, there is something in the mix, but at the same time, SEBI's guaranteed them price protection, which is really what they want. Because at the end of the day, no one has a concern in disclosing data. It's just that if the data results in the deal failing, that's the problem. And they've solved for that here. They said that from the date that you effectively have a price spike, which is on account of the market rumor, till the date after you verified the market rumor, your price is protected. You look at the price as on 1 day prior, and the same price sort of continues for a period of 60 days or 180 days, depending on the nature of or the stage of your transaction. So overall, I think it's a great move, and this will definitely help public M&A deals in India.
So, Abhishek, let's just, help us understand this with an example. And I also want to understand what it does to the secondary market, traders or investors. So if, let's say, there is a deal happening, and this is not just preferential issues, right? It could be maybe an M&A deal, any kind of deal, right? If there is a deal happening and there is a price X, the rumor comes in, the price becomes X plus 20, then for the purpose of calculations, the 20 is taken away. But is there clarity on what happens to all the speculative buying and selling in the interim, in the secondary market? And how do you think this will play out?
Right. So, okay, that's a very good question, actually. So there are two parts to this. The first part is the people who are entering into the transaction, right? So here, let's assume a situation where you have a secondary sale. The promoter of a listed company is selling his shares to a third party, for example, a private equity buyer. Or another situation could be where the company itself is doing a primary issuance to a third party, which is, again, let's assume a private equity player, right? Now, what would happen is the price protection is there to only protect these transacting parties. It's not there to protect your daily sort of traders, your retail guys who are trading on the exchange. The idea is that they are given information, and now based on that information, the stock price moves up or down, and they take an informed decision. But the people who've done a negotiated deal, their price is protected. So if you do a secondary sale, somebody is buying a stock at 100 rupees. This is negotiated as part of the share sale transaction. Now, when the rumor hits, the stock price suddenly goes up from 100 to say 120 or 130 over a period of a week, 10 days. Now your negotiated SPA price will still stay 100, right? Because that's your agreed commercial price. But your open offer price, which is under the takeover code, will suddenly go up because that's based on a 60-day volume weighted average price. Now, what happens there is the overall deal value has gone up because while they were earlier assuming that they would do the underlying SPA at 100 and the open offer at 100, the SPA remains at 100, but the open offer has gone to 120. What this does now is that it ensures that your SPA and your open offer both stay at 120. So the parties are fully protected. But for third parties or retail traders, this protection is not really for them.
I guess, I mean, in terms of instances where an open offer is getting triggered, I think third party is still sort of impacted. Positive or negative is a different connotation, but because these new rules will impact that that open offer price, like you mentioned. But I guess in other instances where it's just a deal, it's just a placement, that's where the question is, what about protecting retail interest? Sandeep, comment on this. But should we be so worried? Because I think they've also put a time cap to this, right? Companies have to verify within 24 hours. So whatever speculative games are happening, I mean, the parties transacted, they're protected. Rest of the janta, but I guess we're only talking about a 24-hour window. So essentially, it's just one trading day in which people can play all kinds of games. So nothing to get too worried about.
Not at all. In fact, maybe a little unpopular for saying this, but I think you have two classes of people here. One is the company and the investors bringing in money through this QIP issuance, which is going into the company. And the other classes, we talk about punters who are going in and out 10 times a day. And I don't think the second class needs any protection, really. It's the first class which needs protection, which is really kind of money which is going into productive uses. Anybody who's invested over a period of 1 or 2 or 4 years is not going to care about any of this. So I really don't see any point in protecting punters. I think it's more important to protect the investors who are there for the long term, who may have come in through maybe in foreign direct investment route to invest in a company which is then going to use it to improve a plant as opposed to ensuring some kind of benefit for people who move in and out of the market on a daily basis.
Abhishek, quick word on Sebi's consultation paper on buyback. What are the key tenets and what have you made of it?
Yeah, no, I think it's a good move. The idea being that they are covering a few sort of gaps that were there, especially on the ESOP sort of flexibility to participate, etc. This has been a concern for a while, and it's good to see Sebi just plug those loopholes now. And I think the general trend for Sebi has been that. If you see that it is a regulator now which is listening to the industry, it is trying to plug the loopholes to the extent possible.
Very quickly, we just have 10 more seconds. Sandeep, on another important point where, companies are coming in listing and then there is the minimum norms that promoters are bound by. I think now the rules are saying that certain other category of non-promoters, their holdings can be clubbed with the minimum promoter lock-ins that are required. How do you view this?
Yeah. No, I think that's also an excellent move because what has been happening with all the new age promoters was that they did not have a significant stake in the company, and most of their assets are really paper money, right? So you might call them billionaires, but all the money is in one company in shares, and therefore I think this ability or the flexibility of allowing other people to also contribute towards that is going to have actually very significant impact on the quality of issuance which comes in the future, because many people who could not come to the market because of lack of cash will now be able to meet those requirements.
Okay, so perhaps good for new age companies as well. All right, gentlemen, thank you very much. Really appreciate you joining in and sort of simplifying to a large extent some of these pretty complex new moves that Sebi is looking at implementing. Thank you for tuning in. By the way, just a reminder that these new rumor norms and the unaffected pricing norms for top 100 companies of the country by market cap, they come into effect from the 1st of June. Completely out of time on this edition of Trading Hour. Thank you very much for watching. Stay tuned. Halftime report coming up next.